Hello, folks. Brandon Chapman today. It's another edition of the Monday video for TheoTRADE. We're approaching the Christmas holiday. We're talking about a holiday shortened week. We're talking about a short trading session tomorrow. We're talking about, again, next week. We had January 1 as we turned from 24 to 25. And it makes you wonder, like, who's posturing for certain positions going into 2025? I'm like, it seems like people are pretty certain that next year is going to be pretty bullish. But is that reality? With the notes we've had on inflation, obviously the PCE data last week was not as bad as we thought. The market sold off, then rallied, and then fell off from the highs, never really closing above the high from the prior day. We ended up finishing kind of inside that range. And today, it looks like as we're about to close here in about 15 minutes, we'll probably finish within Friday's range as well. So what does it hold? Not just for the next week, but really, what does 25 hold? With a rudderless Fed, and again, maybe not cutting rates again. Again, the standard's going to be a bit higher. They're going to focus on maybe on other measures. What is going to happen? And this is where do you take the FOMO trade that's really driven the market over the last 2 years? Coming off a bear market in 2022, we're down over 20%. The market really came into 2023 with a much more bullish tone. Volatility was elevated, skew was down, and it really opened the door for that upside potential. Well, guess what? We've realized that upside potential. Skew is trading at near record highs. Yes, we've come off in the last week, but coming off of record high levels just a little over a week ago, we're only down to 161, which is extraordinary, which basically says what? It says that institutions are almost as hedged as they've ever been. What are they hedging? The downside risks. This is exactly what we've been kind of talking about over the last few weeks, anticipating a market correction. Again, a correction is 5 to 10%. Now, we've gotten that 5% off the highs, nearly a 5% drop from the peak to trough here a couple days ago. But again, is that all there is? Maybe for 2024. But as we enter 2025, what are we talking about? A Fed that is cutting rates in response to a jobs market that's pretty weak, inflation that's still running high. We're caught in this little bit of a trap. And what is the Fed likely to do? At this point, I don't think anyone really knows. What's inflation going to do? They're 23,000 employees at the Fed certainly can't predict what inflation is going to do. So again, their policy will likely remain rudderless. They're likely to be behind the curve. They're likely going to have to respond to data. And again, part of that data are stock prices. My expectation as we enter early 2025 is that we may see the market underperform things like, for example, let's say gold. Now, gold historically bottoms in December and generally has a pretty good January into February. Last year, we had a big rally going in. We kind of wavered for a little while, and then we began to pick up the ball in late February and March, and we really took off. But again, in this case, we're coming in gold prices being down, which is typical. But January, since 2014, has generally been a pretty bullish period of time for gold prices. So I'm kind of expecting the dollar to soften a little bit, weaken, going into early next year. That may help gold prices. And it doesn't necessarily mean that the market's going to really sell off hard. It just means what? It's likely to underperform, especially in January, and that will set the tone for the year. And we'll see how that plays out. And gold is key in that. Now, obviously, gold typically does well when interest rates or yields on treasuries are going down. So if we look, for example, TNX, CGI, keep fat fingering it here. You'll notice yields are pushing up against highs. Are we going to start to see some degree of relief? Maybe, especially if the economic outlook starts to diminish a little bit. In which case the dollar may strengthen again. But again, we might start to see some of the sell-off in the bond market just kind of moderate a little bit and open it up for the market to stabilize, at least in the short term. And really what that stabilization leads to is a lower VIX. And if we get a lower VIX, we might see the VIX really trade a lot lower than the 3-month VIX. And we take a ratio of the two, the 3-month and 1-month VIX. We may see this ratio push back up in dangerous territory where the 3-month VIX is higher than the 20% higher than the spot VIX. You'll see it over here on the right. So we have things developing, right? The market may continue to see a rally into the end of the year, but in very, very small moderated terms, if we go back to SPY here, we may have a chance of getting back to 605. Don't expect to see a lot of volatility, but we're watching the VIX to really see how hard do we sell the VIX, what kind of relationship does it have with 3-month volatility. And if that really starts to tip towards that 20% threshold or 1.2, again, that would say the market's starting to reveal those downside potential. And so as we price that in, that's where gold can bottom and start to outperform the market generally. And that's kind of what I'm expecting right here. Now, gold has lagged a little bit, but gold for the week, it's still the fourth best performing asset. It's outperformed the S&P over the course of the last week. Again, gold generally outperforms the S&P when it goes down. And again, if the S&P is expected to be weak going into January, which is my expectation, I expect the gold probably to find a bottom here shortly, maybe even in the next week. And we may see a little bit of a golden opportunity play out in gold. Now, if gold's outperforming the S&P 500, we're probably not seeing a lot of those FOMO-driven stocks outperform. Maybe you see the Magnificent Seven, your Apples, your Googles, your Metas, your Microsofts, those kind of companies, Amazons. They may hold up okay and holding the S&P 500 up. But is there anything out there maybe just beneath the surface that maybe you're not looking at right now that may present opportunities? Now, I'm going to give you 4 stocks that the option market is looking at and trading right now. The first one on the list is J&J. Last week, I saw some strength in like AbbVie, for example, ABBV, Pfizer, again, some option trade, looking at healthcare. In actuality, healthcare is the best performing sector in the last week, and it's the best performing sector today, just barely beating out technology. So we're looking at J&J, a healthcare stock. Well, let's back this out a bit. Let's go to a 10-year weekly. J&J is down a fair bit off of the highs. If we kind of measure this retracement from the low down here to the high, we're sitting on about a 1/3 retracement. If we're not going to see any bigger move in the broader market, there's a chance this might be an area where J&J can hold. And the yield right now, and let me just show you a tool here. We're gonna look at J&J, and I'm just gonna go by, this is kind of a conglomeration. I got to bring up the right tool here. J&J. We'll bring up the summary. And this is Guru Focus. Again, they tend to kind of reflect a bunch of stuff in terms of valuation, and they'll kind of price it here. Again, they're showing this might be a stock might be as undervalued as 30%. Again, it's a pretty 20%. Again, you look at some of the ratios down here. You look at, for example, EV to EBITDA is one that I like quite a bit. Sorry, to scroll down too far here. EV to EBITDA, again, we're at about a 14. You're less than a 15. That's generally in a valuation territory for any stock, and it's below the median value. So again, a stock that may be trading at a discount. You look over here, revenues are expected to increase in the next couple of years. That's what's creating this kind of upward trajectory here, but definitely trading below what might be considered fair value in a lot of respects. So modestly undervalued. Well, it also pays a yield. So if we look at dividend yield right now, it's about 3.41%. It's basically the highest dividend yield the stock's ever paid. So again, you get a stock that's trading maybe at a relative value. You have a high dividend yield. And right now you're seeing the options market begin to step into this stock. Now today, the trade in J&J is for a June expiration. So it's out there a little ways. We get out here to June, not much of a gamma squeeze potential given this long, but it's an indication of money flow. You'll see 13,000 contracts mostly bought at the June 155. So basically you get about 3.5% yield to wait to see if the price goes up. You have a catalyst, you have money flow coming in, looking at 155, which is barely above where it's currently trading. We could readily look at this thing maybe retesting 180 again in 2025, plus you get the yield. And right now where the market is given valuations of the S&P generally, that yield and then on top of a market return may actually provide a decent yield for 2025, and it's a lower beta name as well. Let's take it another one. This one does mine for gold. It's not a pure gold play. It is a metals play. They make a lot of money off of copper, etc. FCX is back down again. around a couple year low. I mean, last week we tested lows from 2024. We're off some of our lows from 2023, but this is a significant area of support for FCX. And so if we can hold this, we may see us rally off this point and may have a chance to make back some of the sell-off here. And I'm going to delete this one. I'm going to draw a whole new line off of this high down to this low, a 1/3 to 2/3 retracement. That's a 46 handle. We're currently trading at 39. That gives you almost a 20% move plus the dividend. What's the dividend yield right now? The dividend yield is only 1.5%. So this ends up being a little bit more trade. The yield's there to give you a little bit of a kicker on top of it, a bit of a stocking stuffer. But if we look at this one, again in the June expiration, 26,000 contracts at the 45 strike, mostly bought. Now 45, we're approaching the 50% retracement. No reason that couldn't overshoot to 47. So this would give you the target zone. Let me just back that out again. This gives you that kind of target zone here between 45 and 47 for FCX, coming off a significant potential area of support down here. Again, you might give it back to 36.50. That might be risking 3, but you got $7 of upside here and the dividend. Again, providing that kind of mixture that may allow you to see something if the gold starts to perform, if copper starts to come back a little bit, you could readily see FCX rise. And again, the option market today is looking for opportunity in FCX. Another trade is on Qualcomm. Now this is, again, we're talking about different sectors. We're diversified here a little bit, but the common theme is these are dividend paying names. Now again, are you buying a stock exclusively for a 2% yield? No, but here's the deal, right? So if we go back here, we'll bring up a group focusing. I'll just show you, again, it's QCOM. Now again, right now, if you can get a stock for fair value or maybe slightly below, and you'll notice right now Qualcomm's trading at around fair value. You come down here, you'll see the forward P is less than 15, factoring in next year's earnings. We look at an EV to EBITDA. Again, it's moderate, right? It's around the median value. So this stock's probably trading around fair price, but it's a yield payer, and it's one that is a big cap tech name that might do okay leading into 2025. And you know what? I forgot to show you this for FCX as well. So we'll bring up FCX on the summary page here. And again, this is one that if we look at FCX from a valuation level, you'll see that we're actually trading, again, based on their estimations, below fair value. A lot of these metrics, EV to EBITDA is very, very low. But notice we're expecting revenues to increase 25.9, 27.3, 29.4. So point being is that we're expecting revenues and profits to increase, and we're trading at a very, very low level that belies that 7 handle on EV to EBITDA. And we look at P ratio, forward P at about 18. It's moderate, but again, trading below likely fair value in this case and paying a dividend. Let's take a peek at another one here. This actually, Qualcomm. The trade on Qualcomm is at a February expiration. So we'll come in here. Sorry, I missed a couple here. On Qualcomm, it is an upside call spread, buying the 165s and selling the 185s. The skews against this trade, it's a little bit of an expensive spread, but as a stock trade with a yield looking at 180, again, that's $22 above the present level, close to 15% and maybe more out of Qualcomm in conjunction with the yield. The last one here, this one actually, the trade occurred on Friday, but I'm going to talk about it. We're kind of holed up here at support. You back this out to like a 10-year weekly chart. We kind of draw this line, this Fibonacci retracement from low to high here. We're about the 50% retracement of the bull trend, a very typical area where stocks find support. You can see a couple of other major levels of consolidation at this point. We touched it a couple of times just in the last year, and we're currently trading near that level. Now, this is an auto parts store. Are people about to start to fix their cars more? Our average age of vehicles are near record highs. These are the kinds of things that come together. There was some significant volume on Friday, and we're kind of holed up today. And on Friday, there was trade. You're not going to see it on the volume side. You might see it on the open interest out in May. So all these are a little bit longer dated. But this is out here in the May 37.50. So that open interest was billed on Friday. But again, it pays a 3.25% yield. It's trading at a discount. And it's these two qualities that we're looking for in these kinds of companies that are paying dividends, trading at a good valuation, that may present opportunities leading into, and you'll see down here, maybe 30-40% of are undervalued. Again, very, very low EV to EBITDA 9. We've got a price to forward P ratio rather of 10. Very, very low levels that are indicative of stocks that do have a chance to rebound sharply if favor begins to turn. And we're keying off this option activity to say, hey, they're starting to draw the eye of those in the market. And again, we're seeing the options trade these stocks in particular. And with the dividend yield and valuation, could create an attractive opportunity even in a difficult market heading into 2025. Well, folks, that's the wrap for today's video. We'll catch you back next week. Have a great one. Thank you.